Welcome back, traders and investors, to the Benzinga Pre-Market Prep. I'm here with Brianna, and we have with us on the line Kevin Kelly. Kevin Kelly is the Chief Investment Officer at Recon Capital. Kevin focuses primarily on equities and options market. As the CIO, he oversees all research investment strategies. He also serves as a PM manager for DAX Germany. So, Kevin, welcome to the show. How are you?
I'm great. Thanks for having me.
All right, Kevin, so we've got a boatload of technology earnings that we got so far. Which ones are sticking out to you right now?
Well, one of the main ones that stuck out to me was Amazon, right? Because they actually crushed it on the bottom line, but on top line they missed. And they have pretty significant exposure overseas. But what happened is the number that stuck out was the growth overseas. There's only 3% sales grew internationally, and they've really invested significantly overseas. So that's kind of an interesting number that stuck out, because we can see from last quarter when Microsoft reported, they beat. They did very well. Everyone thought the PC wasn't dead. What it really was, it was the upgrade cycle for the operating system. It wasn't people were buying more PCs, and Microsoft even warned. They said, hey, they lowered their guidance. They said, hey, be careful. And that showed in this most recent quarter that they announced, and they were off around some 10%, right? So they were down 9.25%. Because their quarterly profit was in line with expectations. Everyone had lofty expectations. So we're really kind of focused on Amazon with their recent run-up of 20% to really be careful and cautious, because their guidance is just like what Microsoft did. Their guidance is really low. They don't even think they're going to turn a profit in Q1 or Q2. So we're really going to be focused on that. And if they start to get some actual fruition in their international markets, they're going to be hurt by the strong dollar. So we want people's expectations on Amazon to be really tempered. But we think they're making some good headways on their overall business model, right? Moving to third-party vendors, having to carry less inventory, which is kind of more of an Alibaba model. So we like what they're doing there, but we've got to be very cautious, especially after this big 20% move since earnings.
Let's talk a little bit about some of these social media stocks. We got Facebook, and last night we also got LinkedIn and Twitter. What did you see from those reports?
So Facebook did really well. I mean, they beat on the profit side. They beat on the revenue side. I mean, they just cannot do any wrong the last couple quarters. When it comes to Twitter, I think there's a lot of heat on Dick Costolo right now, and their earnings were great. And I think they're going to start implementing some changes to actually see more users sign up and be active. So we're not as bearish as a lot of people were, and you could kind of see that in the after hours, right? I mean, people were bearish, and then now it's positive. So we think Twitter actually has a lot of headway to go. It's irreplaceable. There's not going to be another technology right now that's kind of replaced the streaming. People do go there to get some of their news. So we think they're going to have some great quarters coming up. On Yelp, it's really hard. I think, talk now is for Yelp that they're going, they're kind of in that position where they could be acquired by who, we don't know. But, I think Twitter you got to focus on. I think you got to focus on Facebook. They are actually like Google, right, where they become verbs, right? Facebook, me, or, check out Twitter. So they're indispensable. So I think when you come to Yelp, they can't get competition from some of the big guys, right? Google can step in. We think Yelp could be an acquisition target. Maybe Yahoo needs to make a move. Yahoo's value was completely derived on Alibaba. So they're going to go out, and Marissa Mayer needs to make some moves. So we'll see what's going to happen. Tech's earnings were really mixed. So, we're really going to have to see in the next couple quarters what happens, because all these companies are cash flow generative. They're also distributing out to shareholders. So we're going to have to see what they do on the investment side for future growth.
What about GoPro? Do you follow that? I mean, we saw some pretty interesting after-hours and pre-market trading action in that.
Yeah, GoPro is actually a very interesting company, because if you look at it, they're really a hardware company, but they're selling a lifestyle, and they're trying to get into this whole social media movement, right? So this action sports movement. And we're going to have to see how that takes hold, because people were talking about fads earlier on the show, and it's like, could this be a fad, right? One of the beautiful things about Apple is their iPhone took a bunch of different gadgets, compiled it into one, and then all of a sudden it displaced the camera, it displaced a bunch of other things that people used. So GoPro is kind of late to the game. Could GoPro be displaced by future technologies? Maybe. The social media aspect, is it a fad? We don't know. I think we're going to have to wait and see. It's too levered right now for me on the PE side. So we like to stand back. We're going to need to see a little bit more history and sales come out of that company.
And we can't not talk about Alibaba and of course Yahoo. Alibaba's second earnings report. What do you think of this company? I know a lot of people are sometimes afraid of trading companies, shortly after their IPO, but I'd love to get your take on this.
Yeah, Alibaba is it's a great company, right? So they reported quarterly revenue that was below expectations. Well, there's really not a big surprise there, because the expectations were so high. So if you liked the stock before, you should love it now. One of the ways you could actually get in is through the options market, right? So there's a lot of volatility still in the stock. So if you own it, you could scalp some of that volatility. It's a great company that has their hand in so much. And listen, I mean, they're the number one player in the number one growing economy and market in the world, right? So now that expectations have been checked, it's going to be a great company going forward. I mean, there's no doubt about it. So we think you're getting into the early innings. There's going to be some lockup. There's going to be more stock coming out. There could be some more hiccups and bumps. But if you're a long-term holder, it's a great way to get in now. I mean, it's looking back to, Google had the same problem when they went IPO, right? I mean, it ran up, it missed some expectations, it kept growing, and, here we are now. So, they're the only player over there. So either you got to get exposure through them, or, you're going to have to try to go to a different country to get different exposure.
What about Pandora? I mean, I think they started off pretty well, but it looks like they're trading down, and I don't think they had a fabulous earnings report.
No, they didn't. And Pandora has been up, down, all around. It goes back to licensing. You got to kind of think of it like how Netflix has to license content, right? So with Pandora, they're in a tough market just because there's so much competition with Spotify and now Apple with Beats by Dre, and they're going to try to do a streaming service. So, Pandora was one of the first in the game. They've got a great business. It's just, the competition is so stiff. So this really isn't a surprise. I mean, they've had some earnings problems in the past. It's so volatile that with so much uncertainty around it, it's really hard to trade a name like Pandora, especially when they're going up against so many new innovative companies that are just with music streaming. That this investors can't be surprised by this.
And to think, I just renewed my subscription for Pandora too, and that wouldn't boost it up. So, Kevin, let me ask you, we're taking a look at, we're kind of talking some of the more broad impacts here. You're talking about Alibaba and some of their international actions, and I just want to ask you if I could, specifically, what's going on in Europe?
Well, what's going on in Europe is they have significant structural problems, and they think quantitative easing could help solve that, right? It's kind of a Band-Aid. So you have the Bundesbank and you have the Germans really trying to fix those structural problems, as opposed to everyone else in the zone that thinks that quantitative easing could be a panacea, but it's not. So there's going to be a lot of strife over there, especially into the foreseeable future. I mean, they talk, Draghi came out with the ECB's actions and kind of gave it as an open-ended quantitative easing. He's saying, we've got this target, and until we meet it, here's the timetable. We're going to try to go out till September of next year, but we can go further if we need to. So they really left it open-ended. That's the problems, right? The structural issues haven't really been addressed, and you're starting to see, the cultures clash now. So that's what's happening over in Europe. This euro move shouldn't be a surprise to anybody. It's weak over there. The American economy has done very well. And our dollar was really weak against the euro, and it undoubtedly so. So, this move is actually really good. It's probably long overdue. It happened really fast, and we're seeing in the global markets moves really fast, whether it's coming to the euro or even oil. So that's one of the things that's happening with all these quantitative easing programs, is that moves are happening pretty significantly in big commodities and currencies, which is really frightening, because if we go back to the taper tantrum basis point in 2013 in the summer, we saw basis points move 100 basis points on treasuries, which is pretty significant when you think about all the treasuries that are out there. So that's one thing we're really focusing on, is that, investors need to be really nimble and really fast, because these moves are quick.
And they're large too. I mean, I was joking earlier in the show and when we brought you on, but we've had roughly 18 from what I can count, central banks take action since January 1st. And it seems like right now we're kind of in a world of trouble. I mean, if you take a look at when central banks lower rates, specifically in the U.S., even the federal government has to shorten up the maturity on its debt as the rates get lower and increase its nominal debt size. So this puts a lot of pressure on nation states. So I'm curious to see what's going to happen with the ECB there. Go ahead, Kevin. I'd like to get your thoughts on it.
Yeah. No, I mean, you're hitting the nail on the head, because we're not seeing all these countries have implemented these programs, and we haven't seen the growth that we've wanted from it. So they've continued it. But the problem is that everybody is doing it. So it becomes really marginal, especially because when you look at our GDP that came out, and it really disappointed, right? So we were expecting to have, a higher GDP rating, and we came in at 2.6. So what happened with that, right? And everybody, it's just a rush to the bottom, right? So everybody's scraping for additional sales and additional GDP, and it's a currency war now. So the growth isn't there. So now everybody's competing on lowering the value of their currency to get that growth. So, and if everybody's doing it all at the same time, how can it be effective? So with the ECB quantitative easing, there's a clear winner. We're a little bit biased due to the fact that we launched the DAX ETF October 23rd, and that was actually in anticipation of this ECB quantitative easing happening, because Germany has such an export-oriented economy that they're going to win in this. And they're trading at, unfortunately, the companies located in Germany are being hurt because they're located there in Europe, right? So if you look at the names, I mean, just look at the car makers. I mean, BMW and Daimler, they're doing really well. They're trading at 12 times PE, and Daimler even came out and said, hey, they expect profits to rise 10% this year. And they're doing really well in the Eurozone, where Chevrolet got pulled out by GM in the Eurozone because sales were negative. BMW and Daimler, their sales were above 10% of the Eurozone. So, they're unfairly getting hit just because of that. They're large multinational corporations. 60% of their revenues come from abroad. So if you can start looking at companies in Germany that can outbe, European counterparts or even some American counterparts, that's where you want to play. And one name you can look at is Bayer, right? So Bayer got an upgrade from Morgan Stanley over AstraZeneca, which is based in the UK, just off of the currency and sales. So we think there's a lot of opportunity in Europe. And believe me, there's some great multinational corporations based in other countries in Europe, but we just think as a basket, Germany presents that opportunity. And so that's why we launched it at the time. But, with the ECB's actions, they're going to have to do a lot more quantitative easing, and they're going to have to do it in a bigger quantity, as well as they're going to have to move into some sovereign nations and buy some of those bonds that are really, not investment grade.
So with this action from the ECB then coming in, what I mean, if they have to spend their time, excuse the phrase, but if they have to spend their time babying Greece and France and Spain and some of these less fiscally strong nations, what's this going to mean for Germany? I mean, do you see a scenario where Germany maybe leaves over this impact? Does this hurt, Germany's
No,
economy in the long run without them being the focus?
no, actually, Germany, it's kind of like having your cake and eating it too. Germany needs these countries to be part of the Eurozone and wouldn't leave because they're benefiting from the weakness because it's lowering the value of the currency, which is increasing their exports. So they're actually really benefiting from the weakness in the other countries, which sounds odd. And Germany, they own already a bunch of the bonds, right? So they're the biggest lender. So if Greece leaves or some of these other countries default on their obligations, it's really going to hurt Germany, right? Because they own this debt. So they don't want to lose out on the principal of the debt and really hurt their own economy. So, I mean, if you look at their economy, they're running at a surplus. They've got a AAA credit rating. They take a lot of pride in that, but at the same time, they've benefited from it. So over the long term, the Eurozone is going to remain intact, right? Nothing's going to happen to it. We're just going to see really marginal growth, and it's just going to tick along until there's actually going to be some structural reforms that come down. And I think that's why you're seeing Germany right now be really, really stringent with Greece over what they're going to do with their debt.
All right, well, excellent. Thank you, Kevin. I appreciate the comments, and I could talk to you all day about macro. I kind of enjoy doing this stuff, but we're going to have to wrap it up, so I just want to thank you for coming on, everybody. We've been talking to Kevin Kelly, Chief Investment Officer at Recon Capital. Kevin, thank you very much for your time and for your thoughts and input.
Thanks so much for having me.
All right, man. Cheers. Have a good weekend.